Hello everyone, welcome to another video on Canadian dividend investment. This is a case study on how we can attain a passive income using Canadian dividend stocks. I have a well-traded account where I'm building up my portfolio mainly with those stocks, ETFs and REITs that gives me a good dividend. One of the stocks that I'm interested to buy is from energy sector. So today we're looking at some of the stocks and comparing it with each other to see which one should I buy. I am mainly focusing on dividend, but at the same time, I'm also interested in the stock to see how the performance is. So I'm considering these factors as well, but my main aim is still the dividend. So let's see where these dividend stocks stands in our analysis. The first stock that we are looking at here is Enbridge. Enbridge is one of the largest energy delivery company in North America. They move about 25% of the crude oil produced in North America. They also transport nearly 20% of the natural gas consumed in the US. Their three core business is liquid pipelines, where they move crude oil across America through pipelines, natural gas pipelines, where natural gas is moved through pipeline across North America and also to Mexico, utility and power. They operate North America's largest natural gas utility by volume. Enbridge also has a portfolio in renewable energy where they have offshore wind, solar, and geothermal projects in North America and Europe. But if you look at the business mix, they are mainly concentrated on liquid pipelines and gas transmission. Now, coming to the dividend history. As always, Enbridge was always famous for the dividend. They always give high dividend. And if you look at the chart here for last 25 years, they have always been increasing their dividend. They pay out quarterly, and currently the dividend per share is 0.835 cents. So now let's look at the growth chart for the past 5 years. Overall, it's going down. If you look at this chart now, it is not a promising sight for an investor. If you have owned this stock in April 2015, then you would have been in loss now. So April 2015, it recorded a high of 63.06, but 3 years later, it went down. After that, it was slowly recovering and was in an upward trajectory when COVID hit in Jan 2020. Currently, it is started recovering. So currently, the stock stays at 44.49. So one important thing here to see is that even when this stock was going down in this 5 year, they always increased the dividend and the payout was also good. So that is always a plus point for this company. The next stock that we are looking here is Suncor. Suncor extracts and upgrades oil sands into crude oil products and diesel fuel. They have refineries. The refineries are in Edmonton, Sarnia, Montreal, and Colorado. Suncor markets the company's refined products to industrials, commercials, and retail customers. They have Petro-Canada retail and wholesale outlets across Canada, whereas in US they have agreements with Shell and ExxonMobil. Suncor also has 4 wind power projects in operation. If you look at dividend perspective, Suncor has not been as promising as Enbridge was. To a certain extent, till 2019, we had an upward increase in dividend, but after that, the dividend came down. The payout of dividend is quarterly. Currently, the dividend is 0.21 cents per share. If you look at the growth chart of Suncor for the last 5 years, we can kind of split this into two halves. The first half were till 2018 July. It was in an upward movement. The stock was really performing well. And then after July, it slowly started decreasing. And the main reason would be the oil prices, the pipeline issues, and these all didn't help the stock. But after July 2019, that is in the range of like 1 year, it slowly started gaining the momentum. But then that's when the COVID hit it. So if you compare other stocks that we are looking here, Suncor actually has the maximum blow from COVID. It went down to very low levels that it has never seen before. And if you look at it, the current price, that also is like way down compared to the January 2020 price. So it is actually performing like very bad when compared to the 2020 January as well as from 2018 July. If I draw a line here, we can see that it has never went below this line before the COVID, and it has never, or it was not able to cross this line and go upwards. So that shows that this stock is still not recovered from COVID, and we're not sure how it's gonna perform in the next year or so. Currently, the stock is at 22.59. The third stock that we'll be considering here is TC Energy. TC Energy is North America's largest energy infrastructure portfolio. They build and operate a network of natural gas pipelines, which supplies more than 25% of the natural gas consumed daily across North America for homes, industries, and to generate power. They also have oil and liquids pipeline infrastructure connecting Alberta crude oil supplies to US refining. The company also have investment in 7 power generation facilities. From dividend perspective, they always have been giving a good dividend, and if you look at the chart, the dividend is always increasing. So they have consecutively increased dividend for 20 years now. 2021 dividend is not yet out, but as per the company, it would have an increase of 8 to 10%, so maximum of $3.56 per share per year per annum. The payout is quarterly. If you look at the growth chart for TC Energy in the last 5 years, you can see that it resembles a little bit to that of Enbridge, but it has far more growth than Enbridge before the COVID hits. So before February 2020, if you look at it, it was actually a growth pattern. It did had couple of ups and downs, but it was going in an upward trajectory till COVID hit. COVID actually hit this one hard though. After that, it tried to come back to the February numbers, but the uncertainty did push it back. So if you look at the current price, it is actually a good buy. And if you compare it with the previous downs, it's a little bit different than how it was with Suncor. And in the case of Suncor, we saw that right now Suncor is in that uncharted territory where it has never been. But TC Energy, if you look at it, it had two instances where the price was way down than what it is right now. And from there, it did had a huge growth until the COVID hit. So based on those, we could say that this one is a good buy now, and there is a probability that it can go up to the levels of what we seen in February 2020. Currently, the stock is at 55.01, and I would say that this is one stock that I'm interested in buying. The last company that we are looking here is Pempina. This is an energy transportation and midstream provider company. The main core business of this is liquid pipelines and natural gas pipelines, where they transport oil and natural gas products produced primarily in Western Canada. They also own gas gathering and processing facilities and an oil and natural gas liquids infrastructure and logistics business. The company offers a full slate of midstream and marketing services to the customers in the energy industries. If you look at the dividend, they have been paying dividend for more than 20 years. And if you look at the graph here, they have been constantly increasing the dividend, except this year, where so far they have not announced any increase in the dividend. It still retains at 0.21 cents per share. So one of the thing of Pempina is that they pay dividend monthly, so that will make it an annual of $2.52 per share. Now, from the growth perspective for the last 5 years, we can see an upward growth. There was kind of fluctuation as well, but overall there is an upward trend till the COVID hit. And just like all other stocks that we've seen here, the COVID hit was hard on this stock as well. After that, it started coming up. The rise is promising and it really looks to be a very good buy. Currently, it stays at 35.18, and this is one of the stock that I am really interested in. So now, since we have seen at these four stocks individually, let's compare them. So we are looking at three data points here: current market price, current annual dividend per share, and the last point, which is where we are really keen on, is how much of dividend you are getting if you invest $100. So that will help us to know which one for us is the best dividend stock. As we see, this is the current market price of these stock, and this is the current annual dividend per share. For TC Energy, 3.56 is the maximum that it can have. It has not yet announced it, but they mentioned that it would be 8 to 10% of the previous. So I put it the maximum here of 10% increase than last year. Now, if you see the dividend for $100 of your investment, for Enbridge, it comes to $7.49. So that means like every $100 you invest, annually you will get 7.49 as dividend. Suncor, as expected, it's not up to the mark. It is 3.72. TC Energy is good. It has got 6.47. And we all know that TC Energy has an growth prospect as well. Pempina has got 7.16. That's also really surprising dividend. So based on the dividend alone, we can say that the best dividend stock is Enbridge. But considering the growth aspect as well as how it was performing in the last 5 years, we could say that TC Energy and Pempina is the one that has got growth potential and was showing an upward trend. So, and also the dividend is not bad for these two stocks. So from a pure dividend perspective, Enbridge looks good, but from a dividend and a growth perspective, Pempina and TC Energy looks good. Pempina, the better of the two. So now we come to the end of this video, and this is my personal opinion on all these stocks. I hope it has provided some information to you. Let me know your thoughts. Let me know if you have like $500, which stock out of these four you would invest in. Thank you. Take care. Stay safe.